Hello and welcome to episode 367 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, welcome back. How are you doing?
I'm good. It's been another incredibly busy week. I'd just like to say a thank you actually to everybody who's been writing in and providing feedback about the direction and content we're going to be doing going forward, particularly with regards to midweek market. So if you haven't sent in what your view on that is, or your view on the type of content you want to see going forward, do send in your emails. Damien@moneytothemasses.com is the email address. Somebody did point out, which was quite interesting, that midweek markets has quite an appeal to an international audience as well. So something I hadn't really thought about. And somebody pointed out the midweek markets helps them remain calm during periods of market volatility, even though they are somebody who just invests in index funds. And now if you've been following markets this week, markets have been yo-yoing all over the place. So we're still formulating what's going to happen with midweek markets at the moment. It's not officially dead by any stretch of the imagination. So do let us know what you think. So yes, Andy, it's been an interesting week. We've had lots of stuff going on that people are going to start feeling the pinch. We've had interest rates go up, not just here, but across in America. And of course, we've had news regarding energy prices. So that's going to be a focal point actually today. I'm not going to do an investment piece this week. We're going to have a break from investing this week because there's some more pressing topics that we need to cover. But before I go on to that, please remember to review the podcast, because I've actually went and checked the reviews before this recording and we've not had a review for a little while. So please make Andy and mine and the team's day by leaving a review via whichever app that you use to listen to this podcast, and then we will read out our favourites in the coming shows. And who knows, you may even get a Money to the Masses mug.
Okay, so let's get on with the podcast then. So Damien, we're not doing an investing piece this week. What's our main focus? What are we starting with?
So this week, the Bank of England raised interest rates again. So it's the fourth time it's done so since December. And there will be a lot of people out there who might be thinking, well, how does it impact me? And we'll explain that. But more importantly, there'll be a lot of people who probably listen to this podcast and think, hey, I'm on a fixed deal. It doesn't impact me. But I don't want to frighten people. But today I'm going to be talking about preparing to exit your fixed deal, because I think people aren't realizing quite how much their mortgage is going to increase in the near future. And so I want to talk about some numbers and what people should be doing. So everybody who listens to this podcast will want to listen to this piece. We're then going to do something on buy now, pay later. There's been a development with Klarna in particular, how using those services will start to impact your ability to borrow money. So start impacting credit scores in the future. So that's something, again, that's going to be important and affect people who listen to the show. And finally, Andy, you're going to do a piece on energy.
Yes, so I'm going to be covering a short piece on energy and giving a few tips as to what people can do, what help is there out there, and actually whether energy firms can even cut you off if things get really bad. So I'm going to cover a few things, and it's timely this week because Ofgem have announced that they're looking into a few energy firms and the way that they've been increasing people's direct debits, and people aren't happy.
Okay, so let me go straight on with the interest rate piece that I want to talk about. Now, the Bank of England raised interest rates again this week, so we are now at a point where the Bank of England base rate is at 1%. It was previously 0.75%. It's now gone to 1% this week. Now, if we go back to the 16th of December 2021, that was the first rate rise that we'd had from that historic low of 0.1%. And so you can see the direction of travel is that interest rates are going higher, and it's going to impact everybody. Now, just to give you some highlights, the Bank of England was pretty negative in its assessment of the future for the UK economy. So for starters, inflation is likely to hit 10% in the coming months, so by the autumn. And that's partly, or a large part, due to energy bill price rises, something that Andy's going to come on to later in the podcast. But unless the government intervenes, then we could be seeing inflation at 10% later in the year. Now, the Bank of England had previously been predicting that inflation would hit certain levels like 6% by April this year. And every time they've made these predictions, they've come true. So you can pretty much rely upon inflation to hit 10% later this year. And the Bank of England raises interest rates to try and quell that inflation. And of course, there is a danger that if inflation gets too high, then people stop spending in the shops, they cut back on their discretionary spending. All of these things start to impact the economy and companies, and then for people can start losing jobs. And it's not surprising, perhaps, that the Bank of England went on record to say that it believes the UK economy will shrink by 0.25% next year. And so that starts to give the idea of a potential recession. And it's something that I mentioned probably earlier this year that was always likely to happen, what with the macroeconomic backdrop globally. Now, first of all, people who are on tracker mortgages, so they are mortgages that do track or have a link to the Bank of England base rate, they are going to see their interest rate increase in line with that Bank of England rate increase very shortly, and their lender will get in touch. People who are on the lender's standard variable rate, so if you've got a mortgage and you haven't fixed and you're not on a tracker, you have probably ended up on the standard variable rate of your lender, which means effectively they can decide what you pay, and that will likely increase as the Bank of England base rate increases as well. So your mortgage is going to go up in the near future. So your repayments each month are going to increase. Now, of course, if you're on a fixed mortgage, technically yours won't change, at least not yet. And this is one of the key things about this part of the podcast, is that when you're on a fixed deal, after the agreed fixed period, whether it be 2 years or 5 years, then you need to remortgage. And at that point, the rate that you get could be very different to the one that you are currently on. And the reason I wanted to do this on the podcast, because it came to light talking to various different people, they had never really appreciated quite where we're going with the mortgage market, because a lot of people, especially young people, have bought houses in an environment that has only ever seen interest rates pretty much cut or be at historic lows. And to give you an idea, when the inflation was last at the level that it is now, we had interest rates at double digits, so more than 10%. And at the moment, we've only just got to 1%. So if you think 1% is high, then bear in mind that the Bank of England base rate is still artificially low. It's still effectively an emergency rate where they've tried to save the UK economy. Now, as inflation is getting out of control, they're having to raise interest rates. So one thing that is very difficult for people to grasp is the talk of percentages. So a percentage increase, what does it really mean? Now, I want to make this very simple. I did a piece on Instagram this week that was incredibly popular, which is why it inspired this part of the podcast. So the 0.25% increase we saw in the Bank of England base rate, what does that mean for the average UK mortgage borrower? So if you look at a typical mortgage in the UK, let's say it's for 25 years, then on average, they will see their monthly repayment, so the monthly amount that goes out of their bank account, go up by £13, so between £13 and £14 per £100,000 they've borrowed on their mortgage. So if you've got a £200,000 mortgage over a 25-year period, then you are likely to see your mortgage go up by £26 in the coming weeks when your lender starts to push up their interest rate. And of course, that's assuming you're on a standard variable rate or a tracker mortgage. If you're fixed, you won't yet have an increase, but it will be in the pipeline, as I'm going to explain. So since December, we've had 4 rate increases, and the total impact per £100,000 that a person has borrowed on a mortgage would be £47 extra they're now paying a month on their mortgage than they were back in November, for example. Now, that's a significant difference, which is obviously squeezing people's finances even further. Now, if you have a 20-year mortgage or a 30-year mortgage, the numbers I just gave there still are broadly the same. So it's a good finger in the air to work out how much your mortgage is going to go up by. But the question then becomes is how high are interest rates likely to go? So if you believe the market is pricing in that the Bank of England base rate will get as high as 2.5% by this time next year, so by about mid-2023, in order to try and control inflation. Well, that's another 1.5% higher than we are currently. So if you go back to November last year, 2021, when the base rate was 0.1%, to get to that 2.5%, then that's a 2.4% increase from back in November. And the reason why that's important, because if you went on a fixed deal, let's say back in October, November last year, and your fixed deal might expire in 2023 because you may have a 2-year fix, then what you've got to realise is that effectively the level of the mortgage you might potentially get, assuming that firstly the lenders are going to lend to you and all your other circumstances are the same, the equivalent deal that you got back then, say in October, November, your rate will probably be 2.4% higher than it was back then. And what that means is that for a typical mortgage, you're going to be paying an extra £111 a month more per £100,000 than you are currently on your fixed deal. And that's because the market has moved to take account of the rapid increase in the Bank of England base rate. So let's say you've got a £200,000 mortgage, then you're looking at £222, say, extra a month you're going to have to find this time next year, and that's going to be every month. If you've got a £300,000 mortgage, we're talking £333. These are average numbers I'm using, and in order to work out exactly what the impact is going to be, you can go and use a calculator that we've got a link to. We'll put it in the show notes and on the post on the website, but the web address for it will be moneytothemasses.com/rate-rise-calculator, and you can put in the details of your mortgage, and you can put in the anticipated rise in the Bank of England base rate, and you can see how it impacts your monthly payments. So you can play around with that calculator. And the reason this is important is because everybody now needs to start taking steps to cope with this rise going forward. We don't know it's going to happen because obviously if the economy crashes, then the Bank of England might not be able to raise interest rates quite as the market is predicting. The government may step in. There's all these unknowns, but you can only look after yourself. You are responsible for your own finances. So once you know what the potential damage could be going forward, well, you need to start planning for that new world. And what came to light when I was talking to some people about the interest rate rises, there were a lot of people who just thought, you know what, well, that's fine. When I come off my fixed deal next year, I'll remortgage and I'll probably be able to get a lower rate of interest. Now, that is almost certainly not going to happen because it's like the tide going higher. All boats rise at once. So the rate that you would have got a year ago is not going to be available to you anymore, because think of it, generally speaking, every mortgage rate available in the market will have gone up by 2.4%. So you might not get a cheaper deal because all the rates out there are going to be higher than the one that you fixed on. And there's a lot of people who don't understand that. Some people listen to the podcast might be surprised, but don't forget that lots of people have bought houses in a world where mortgage rates were just basically artificially low or kept going lower, and the price of their house was continually going higher. Because don't forget, when you get a mortgage rate, it is also based upon your loan to value. So how much you're trying to borrow compared to your house price. When house prices are flying, then your loan to value starts to drop as you're repaying your mortgage, and you get better and better rates because there's that much wiggle room for the lender in the equity in your property. So basically you get a better rate. But of course, if property prices don't continue to rise, then you could have an issue as well. You're not necessarily going to have a better LTV than you did when you took the mortgage out. So people need to understand the potential problem that's coming for them in the future, and they now need to start to try and mitigate some of that damage. So I'm doing this with my own finances, despite the fact that I am not remortgaging anytime in the near future. Now, once you know your mortgage details, you now need to start to think, well, how am I going to cope if my mortgage goes up by £200-300 a month? Well, you might have to start cutting back. And I know we're already doing that with the cost of living crisis, but if you're fortunate enough that you're able to put more money aside, then perhaps it's not a bad idea to start building a bit of a mortgage buffer. So you start putting money aside to help subsidize your mortgage payments. So it's a bit like a cash buffer, but this is going to be used for your mortgage, a pot of money that you can take a few £100s a month from to help offset that increase until we get to a point that maybe we've gone through this economic cycle and we get out the other end and mortgage rates might fall again, or you might be able to get a better deal, house prices might have increased, your LTV might be better, etc. And so that gives you a way of coping with something that's going to be a bit of a squeeze. So it's a bit like fixing the roof while the sun is shining. The other thing is I would look to try and keep improving your credit score, because there is an assumption that's there, like people assuming they'll get a better rate just because they remortgage, which probably won't be true anymore. It's almost certainly won't, in my view. If we get these continued rises in the Bank of England base rate, you're also assuming that you're going to be able to get a mortgage from the lenders out there. Let's imagine that we do go into a world where the economy starts to shrink, house prices might stall, you could even get to a scenario where they start to fall maybe, then lenders might start tightening up their lending criteria. And so they might be a little bit more picky about who they lend to. And the best mortgage rates also go to the people with the best credit history. So you want to make sure you are squeaky clean when you're going to apply for a mortgage, whenever it is in the future. So don't get to the point where you're suddenly thinking, I'm going to have to remortgage in the next month or so, and you haven't already gone and done some of those mortgage checklists that we've talked about on previous podcast episodes. If you just search for them, you'll find them. But just to give you a brief recap, I would make sure I was clearing my debt if I could afford to. I'm making assumptions here that you've got some money, that you're not quite on the breadline at the moment, but if you've got some money and you can start to pay down debt, then I would do to start to reduce the amount of credit card debt that you have. Also, try not to use any more credit and try to reduce your financial commitments. So, for example, don't start taking on more direct debits and standing orders for each month for services that you might not need. So I'd start to do a spring clean of all your direct debits and standing orders. Do you need these services? What are they that you're paying for? Do you need the gym memberships? And I do this myself all the time. I'm slightly obsessed by it, and I keep trying to cut back. And it becomes quite an addictive thing to do, and actually rewarding, because not only are you financially better off, but you're taking control. But if you can also afford it, then try to move some of your payments to annual payments. So if you can afford to pay for your car insurance annually or your home insurance annually, then do so. Not only is it cheaper if you do it, but it also won't appear on your statements if your mortgage lender, when you go to remortgage, requests them. You won't have all these financial commitments that you've got. Of course, they'll know you're probably paying for certain things like home insurance and make allowances, but you're not going to have all these commitments to gyms, etc., that they're going to deduct off when they assess your affordability. So start to live like you are going to be applying for a mortgage and scale back. The other thing I would do is speak to a mortgage advisor early. So don't wait until you're just about to mortgage. There's nothing wrong with speaking to a mortgage advisor a year ahead of time. There will be someone out there who will talk to you because they know they're going to get the business when you come to actually remortgage, and they can look at your situation and say, yes, this is the type of deal that you might get right now, but it may also help you in terms of them being able to point out things that you might need to change. And some people out there, if they run their own businesses, can dictate the amount of money that they earn, which also will mean that they can have sufficient earnings over a period of time to warrant the mortgage they're going to apply for. So there is a lot to think about in even the years leading up to a remortgage, because you want to have a reliable history of earning money. So you don't really want all the peaks and troughs as well. And a mortgage advisor could advise you about the trends in the market in terms of what lenders are looking for. Of course, if you're employed, you want to maximize the amount that you're going to earn. You don't always have a say over that, but of course, there is the ability to change jobs if you want to. But again, we're moving into recession. Who knows what is going to happen on job security more generally? Of course, if you've got a mortgage now, so you're also on a fixed deal, if you speak to a mortgage broker, they will be able to tell you what other options you have. So you want to make sure that you're on the best deal now, because you might not be on the best deal. You might end up being on the SVR, for example, and you might be able to get onto a better deal already, or you might be on a tracker and you might decide to fix. They can help you make those decisions, but also it is possible to remortgage early even if you're on a fixed deal. Now, there is going to be an early repayment charge, and there's going to be other fees that are going to be included in that. And of course, early repayment charges can be expensive. They can be like 1 to 5% of the amount that you've borrowed, so you don't want to pay them unnecessarily. But there can be instances where it may be beneficial if you're near the end of your fixed period that you might decide that you want to fix now, and they can look at the numbers for you. And it also can be possible, although I don't know anyone who's done it, but it is theoretically possible to be able to renegotiate a new fixed deal with your existing lender if you're coming up for a remortgage, and that can enable you to go onto a new fixed deal without paying an early repayment charge. But again, speak to a mortgage broker. So I don't want to scare people, but I want people to start thinking about the world that we could be in a year's time. And of course, one other last thing I just want to add is you might want to rethink any large scale purchases going forward, because you might want to have that buffer of money that you might need, because we are all entering this world of a squeeze on our finances. And I know the market's view on interest rates and what's going to happen does change. So I've given this link once before on the podcast, but if you go to bankofengland.co.uk/statistics/yield-curves, and again, we'll put a link in the show notes. This is a page that shows various different charts to do with interest rates and gilt yields from the Bank of England. And the chart at the very bottom of that page is one that shows you where the market believes interest rates will be in the future. And at the moment, it's predicting that interest rates could be 2.5% by mid-2023 or by the back end of 2023. That can change. And then the Bank of England might have to be forced to cut interest rates slightly to cope with an economy that might be slipping into recession. That's what the chart says at the moment. It does change, but it's good for people to be able to watch it, because as they get near to remortgaging, they might want to see what the market is predicting. And even if you aren't near the end of your fixed term introductory period, it's still useful to keep an eye on these things, because you can then take the necessary actions on your own finances. And one final thing I just want to mention before we finish, I've mentioned people on different types of mortgages, but also renters. Now, renters, I know if you rent and you listen to this podcast, you aren't going to be impacted straight away by any interest rate rises, but inevitably it seems landlords will want to pass this on if they keep rising. So it very much depends on your own landlord and whether they actually swallow any increase or what type of mortgage they've got. But of course, when your rent comes up for being renegotiated, you can expect that your rent will probably go up by at least some of the numbers that I've been mentioning for people who have mortgages. So it's definitely something to bear in mind. And one thing I just thought that I had missed off my list of things people could do is overpay their mortgage. Now, that is one option that is available to people all the time, where they can overpay. And there is a limit to how much you can overpay, but obviously, if you overpay, you can reduce debt while your finances are in good shape, and it will lessen the impact, theoretically, of any rate hikes going forward in terms of your ability to afford to repay your mortgage. But I think for a lot of people, that isn't going to be one they're going to be doing right now. It's probably more likely they're going to be trying to be defensive with their finances and build a buffer of some kind.
Okay, so let's move on to the next piece of the podcast then. And we're going to be bringing in Laura. So Laura, what are we going to be talking about today?
This week, we saw an announcement from Klarna, the buy now, pay later giant, that they're now going to be included on credit reports with both TransUnion and Experian, two of the main credit reference agencies in the UK. This is quite a development. Like previously, Klarna has really marketed the fact that Klarna payments aren't included on credit reports, that they won't impact your ability to borrow more money in the future, they won't influence the way that lenders view you. That's now quite dramatically changing, and those payment agreements that you take out with Klarna are now going to be included on those credit reports and will be visible to other lenders when you're looking to take out finance in the future.
Okay, so this came a bit left field. We weren't expecting this. Klarna have effectively changed what they had previously said, and now they are going to be reporting now. So how is it going to work? Is this going to be done straight away, or is it in stages?
Yeah, so these changes are going to come in on the 1st of June. So it is worth noting that if you've used Klarna in the past, then those arrangements aren't going to feature on the credit report. It's only new arrangements that are taken out from the 1st of June that will then feature on those credit reports. It might be helpful at this point just to have a quick reminder of how that whole system works. So there are three main credit reference agencies. So there's TransUnion, there's Experian, and there's Equifax. And all of those collate different information from different financial agreements that you've had, but not all of them have information from the same sources, and they present that information slightly differently, and they come up with an overall credit score which is likely to be different across those three different agencies. What's going to be happening from the 1st of June is that Klarna is going to be reporting to both TransUnion and Experian. It isn't going to be reporting to Equifax. And actually, at the outset, it isn't going to impact that overall credit score figure. they're estimating that it could take up to 18 months to have the mechanisms in place for those Klarna arrangements to influence the credit score. But generally, straight away, it's immediately going to be visible to lenders. And what we're not sure of is how lenders are going to view those Klarna agreements, what sort of influence they're going to have on people's ability to get finance in the future.
So I think that's one of the important points, actually, because although each of the three agencies create a score that you can see, effectively a credit score, there is no one universal credit score out there. So when you go to a lender and you want to borrow money, as I was talking about in my first piece, they will look at your credit report and make a judgment and make their own credit scoring based upon what they see. So in my mind, if there are Klarna payments appearing on there, then it's up to the lender how they will judge that and how they will effectively score you. So it links quite nicely to the first piece, because if you are worried about interest rates going up, like I mentioned, and you want to do some spring cleaning of your finances ahead of time, then I personally, and I can only talk for myself, I wouldn't use Klarna anyway, but I certainly wouldn't be using it going forward, because those payments are going to be appearing on credit reports, especially if you could afford to buy the product anyway. Because don't forget, Klarna is just a way of being able to pay for things now, so the buy now, pay later. And a lot of people have been tempted to start using those services, even though they could afford to pay for it all up front, particularly young people. So that is my view, and it links quite nicely to the first piece. You start changing your behaviours. I wouldn't be using the services anyway. And Laura, can I just ask, they've decided to make this change, and you talked about the 18-month period, which would take us basically to the end of 2023. But there is also another deadline that's looming there anyway, isn't there?
Yeah, so this is definitely part of a wider change that we're seeing in the whole buy now, pay later sector. And it's grown exponentially over recent years. And as it stands at the moment, it's unregulated. And there was a consultation by the Treasury that ended in January this year with the conclusion that it does need to be brought under the FCA's control. But it's unclear yet exactly what that's going to look like, and also what the time frame is around that. But I don't think it's a coincidence that we're starting to see these developments, and I think that we can anticipate that there will be more tightening of how these buy now, pay later schemes are administered, and generally how they're viewed by the regulator. It's worth noting as well that while Klarna's presenting this change as a positive, as a way that people can improve their credit score by using Klarna responsibly, other figures from debt charities indicate that already an estimated 1 in 10 people who take out these agreements end up having debt collectors involved with trying to get this money back. That people are taking out these agreements and getting into quite severe financial difficulty much more often than some of these companies would lead you to believe.
So that's one of the key points. Trying to use something like a buy now, pay later service to improve your credit score. There are other ways that you can do that, and some of that is just good housekeeping. And there are other services out there like Lockbox. We'll put links in the show notes to articles that show how to improve your credit score. But there are services that you don't have to take on debt to try and prove that you're good with debt, if that makes sense. And you don't have to take on the really expensive impaired credit cards, those that are available to people who have poor credit ratings, that have extortionate interest rates either. So there are things you can do. Laura's written plenty of articles. We'll link to them in the show notes, and we'll put them on the website as well. One other thing before we finish this, Laura, it's worth mentioning that Klarna have a credit card. We never talked about it on the podcast because we didn't want to necessarily advertise the fact they're doing something new, but it's interesting to see that there is a Klarna credit card now since the last time we spoke about them. What is that? Is it a true credit card?
Yeah, it's not actually a credit card per se. So it's a Klarna card. It's a Visa card. It can be used with any retailer that accepts Visa. And what it does in essence is it's an interest-free card, and you can use it to buy anything in any retailer that accepts Visa and then pay for it in installments. And you can set out on your own terms at the outset how many installments you're going to pay over and what that payment scheme is going to look like. So that's been another development in this area. Klarna are obviously trying to cast their net a bit wider to get more people using their services, perhaps in different places than they previously were. Again, though, it's just really stressing that you need to not be seduced by the simplicity simplicity of using this card in this way, the fact that it is very easy and straightforward to make those purchases, you really need to be checking that you can afford to make the payments. And also in a situation we're in at the moment where things are getting a lot tighter, just because you feel like you can afford the payments now, perhaps you won't be feeling exactly the same way in 3 months' time or 6 months' time if you're starting to really feel the pinch in terms of your wider finances.
And so I think that's a great piece, Laura, because what it does show is that the world is evolving, and these whole buy now, pay later services, there's a direction of travel that's clearly there. And people who may have used those services before thinking they worked in one particular way and how they would or wouldn't impact their credit report, that's now changing. So you just need to be aware of it if you are going to ever be using a service like Klarna.
Okay, thanks for coming on, Laura. So let's move on to the final piece of the podcast then. And it ties in quite nicely with what we've been talking about right throughout this podcast. And it's that sort of cost of living, that squeeze, things that are impacting our finances going forward. And so I'm going to cover off just a few tips for people who are worried about the cost of living crisis and whether they actually can afford the increased cost of their energy, because it's actually going to get worse before it gets better. So it's better to understand the situation now. So let me run through a few things that people can do. Now, the first thing that I would advise people to do is speak to their energy provider sooner rather than later. Don't let debt build up on your energy account. Speak to them before that happens, because Ofgem rules mean that suppliers must offer a payment plan that you can afford. So you should take advantage of that. Open a conversation, open dialogue, speak to them and say, I'm struggling, what can you do? Now, there's a few things they can do. A supplier can do a full review of your payments and produce a debt repayment plan for you. They can also offer payment breaks or payment reductions. They can give you more time to pay. They can give you access to certain hardship funds, and they could give additional advice on how you can use less energy. So that's the first stage. Speak to your provider, they can offer a payment plan. And that applies to people who are on a prepay meter as well, because although you might not be in debt, you might be desperate for energy and can't afford it, in which case they can provide some emergency credit on your prepay meter. The next thing you could possibly consider doing is applying for a grant. Many of the larger energy suppliers can offer grants, and you can find a list of these on the Citizens Advice website. We'll link to an article that's got the details on how to do that. Do be aware that you'll need to provide quite detailed information about your financial situation, and some of the suppliers will ask you to complete quite detailed budget sheet. So just be aware that that's not a simple process, but it is worth doing if you're struggling. Another thing you can do is check to see if you qualify for a government scheme. There's quite a few out there. We'll link to them in the show notes. The main ones you've probably heard of are the winter fuel payment. Now that's available for everyone over a certain age. And there's also a warm house discount and a cold weather payment, which are means tested. So you'll have to see if you qualify for those. In addition, there are energy rebates that the government recently announced. The first was £150 council tax rebate for those that fall in council tax bands A to D. That's being rolled out currently and should be paid to everyone who qualifies in the coming months. There's also another rebate that will be applied to your energy bill in October. Now that one's applicable to everyone. The only problem with that one is we'll have to pay it back over time, a few pounds a month over the coming years.
So that's all the help that's out there, Andy, and it's a nice summary. There's one question that I know a lot of people are wondering what the answer to it is what happens if you just refuse to pay because you can't afford? So you've got an energy bill, you just won't pay it. Do they cut you off?
Yeah, it's a good question. So obviously they'll make multiple attempts to contact you, probably by letter, phone and email if they've got those contact details. And if that fails, then ultimately it will result in that debt being reported, but also possible disconnection. So I'm actually going to cover off the rules around disconnection and who can be disconnected. So if you are someone who's reached state pension age, then your supplier cannot disconnect you between the dates of the 1st of October and the 31st of March. Now, they tie in with the winter months, but there is a little bit of a caveat to that. That will only be the case if you live alone. So you've reached state pension age and you live alone, or if you only live with other people who are state pension age or with children under the age of 18 years old. So you've got to think about that household has to be solely people who have already reached state pension age, or perhaps if they're looking after minors. In addition to that, energy suppliers have been encouraged to sign up to something called the Energy UK Vulnerability Commitment, which means that they will never knowingly disconnect people if they meet certain criteria. Now, most of the major energy providers have signed up to that, but not all. So it is worth checking to see if your supplier is on that list, because if it is, then you may well be protected. Now, what does it mean if your supplier has signed up to that? Well, it gives certain people a little bit extra protection, more peace of mind. So suppliers that have signed up to the Energy UK vulnerability commitment will also never knowingly disconnect your supply so long as you have severe financial problems, if you have children under the age of 6 years old living at home, if you're disabled, or if you have long-term health problems. In addition to that, during the winter months, again, that's the 1st of October to the 31st of March, they will also not disconnect you if you have any children in your household under the age of 16. So that's quite an important point. Check to see if your supplier is on there. If you are struggling to pay and there is a debt building up and you're worried about being disconnected, if you have children in your house, your supplier, if signed up to that, will not cut you off during the winter months. That's possibly a crumb of comfort to some people. And this is something for those people who have a supplier that isn't signed up to that agreement. You're best advised to keep in contact with that supplier. So long as you're taking those proactive steps, they should be willing to work with you to offer a solution that won't involve disconnection. And finally, you should request that they come and visit you at home. Suppliers are able to send a representative to your home to see your living situation, understand your problems, listen to your concerns, and then they can take that back to the supplier and work out an arrangement for you. Now, I can't guarantee that will happen, but that service is available, to take advantage of it. And if after that you're not happy, you can always submit a complaint to the Citizens Advice, and we'll put details again on the show notes.
That's a great piece, Andy, because I actually learned a lot there. I didn't realise about the rules around the disconnection and obviously having children. So I think we're done for this week. As ever, please do review the podcast. Do get in touch with any feedback that you have. Don't forget to join the Facebook group. We can continue any of these conversations that we have on the podcast in the group. There's always a lot of good content that's in there and people willing to share their own experiences. If you want to join, go to facebook.com/groups/money to the masses. And of course, follow us on our other social channels too. I mean, particularly Instagram. I'm now up in my Instagram game now that the craziness of the first 3 months of the year are out of the way, which are always a busy time for anybody in finance. And you'll see me doing more and more stuff on Instagram as well. So I think that's it for this week, Andy. Until next time.
Until next time.